Hi guys, Ope here, One Glance Trader, and in today's video I'm going to show you 4 different ways that you can trade pin bars using the price action indicator that I've created. So as you can see here, what I've got on my screen here, this notepad file, I'm going to talk about 4 different ways that you can use to trade pin bars. Now normally pin bars are used as a reversal signal. So as you can see, 3 out of the 4 are reversal signals, but one of them is actually a continuation of the trend. So what we're going to do, we're going to start with the first one, which is the moving average pullback. Now, what this means is that you're in a trend, however strong, whichever period of moving average you're gonna use, and I'll show you the ones that I use. When price starts to pull back from that trend, touches a moving average, and then jumps back up and continues in that trend. So what we're effectively looking at, we are looking at a pin bar to form at the bottom of the pullback while price is rejecting a moving average. So that's the plan of how you trade that strategy. So what I'm going to do is I'm going to show you an example of that. And the chart you're seeing now is a weekly Euro USD. And for those who aren't familiar with the indicator, I've got videos which I'll link to kind of go into what the indicator is showing. But just to show you the settings that I've got for this particular example is I've put 0 in terms of the range of the pin bar for its check to go back. So this is normally set to 4. So what it's saying is that the pin bar should be greater than the previous 4 candles. But I've taken this off for illustration purposes to show it, and I don't think it's that relevant to have 4 candles back, bigger than 4 candles back rather, in an MA continuation, as well as the minimum number of bars price last went to, because if we're doing a continuation of the trend, you would expect that number not to be very high because price would have touched it some while ago because you are in a downtrend. So again, if none of these actually make sense to you, my suggestion is to go watch the other videos, and I will touch upon it again later on in this video when I look at the other methods on how to do it. So what I want to draw your attention to is this pin bar over here which says 36. So what this is saying is that price, the top range of this rejection wick last time price was at that area was 36 bars ago, which I would assume is probably this bar over here. So yeah, 35, 36, yeah, so that bar there, last time price was there. So that's why, it's not very far, even though this is weeks and this is 36 weeks, but which is what, nearly just over half a year. As you can see, because we're doing a continuation, you're not going to get big numbers over here, roughly. So so the way that you trade this strategy, in my view, is quite simple. So I've got 3 moving averages on my chart. So this is the red, white, and blue. So we've got the red one, which is the fast moving average. In this case, is 20 period. Then you've got the medium moving average, which is 50, and you've got the long-term moving average, which is 100. You could use any 3 numbers, really, to be honest. I've just used these because they're quite standard, used by a lot of people, used by a lot of hedge funds, especially the 100 and 200 period. So I've just gone with that. So as you can see, we are in a downtrend. Goes down to the downtrend, pulls back to here, kind of a rejection over here, and we do actually get another pin bar rejecting the 50 period moving average, and price then continues to go down, but doesn't really make a kind of lower low to a certain extent, and then comes back up, passes the fast, the medium, and then nicely now touches the 100 period moving average, and then sells off again roughly about the same level. So you could even argue that that is a nice support area, so to speak, over there, right about here. Very strong, a strong support level. So why is this pin bar useful, a good indication that price was going to hit off over here. So there's a couple of reasons. So the first reason being that it touches the price is rejecting a significant moving average, in this case the 100 period moving average. The second reason is that you still have all three moving averages intact in the right order. So when I say the right order to kind of determine the trend, you've got it slow, medium, fast. Where you can see here it gets all tangled up, but to see a clear direction of that trend staying intact is that you've got the short, medium and long-term moving average still there in the right order. So that is point 2. And point 3, which is again another one of the 4 different methods, is support and resistance. So if I draw a line about here, you can see, again, remember support and resistance are just zones. So you can see here you got one touch here, which is a pin bar. This one here, okay, would have been classified as a pin bar, but the body is greater than a third of the candle. This is a pin bar and this is a pin bar. So we've got 3 touches here to show that this is a significant level here for price then to sell off. And then lastly is that price closed quite convincingly below the pin bar candle, therefore selling off there. And again, I know this is a weekly chart, so even if you looked at that there, it's 1,000 pips. But if you just did, I don't think anyone will probably have a 300 pip stop, but at 1% of your bank, you can easily make 2 to 1, or you've easily made 3, 4 to 1 there. So that's just an example. Again, these are illustration purposes. This one would have also been a nice one, but then again, the support resistance, you've got 1, 2, 3, 4 touches there. Again, it just made sense there that there. So currently prices, around here, I think we will hit some support area around that figure down there. So I hope that makes sense. So this is again using pin bars as a continuation of the trend. So the second way to use the pin bar is using Bollinger Bands. So for those who don't know what Bollinger Bands are, these are as a measure of volatility, where normally you have a 20 period moving average and then you have 2 standard deviations above that moving average and below that moving average. And effectively what it's saying is that price is normally contained within the bands roughly 95% of the time. So every time price touches or exceeds that band, there is a strong indication that price will reverse. So again, I'll show you an example of that, and I'll try to also show you confluence examples like I did with the moving average one, more than one reason why that price will then turn to give you a better confidence, a better indication of that trade, and have you the confidence to trade. So in this example, again, you're using the Euro USD, and we're going to be using a 1 minute time frame. So just really to show you that you can use pin bars on different time frames, different level of criteria with the pin bar. So the settings of the pin bar, again, I've taken off the candle range, so it's still set. It doesn't look at the previous candles to see how big they are, and I've also got rid of the number of minimum bars as well to check the price rejection on there, just to really show it as many examples as I can. So what we're looking at here, we're looking at this small pin bar over here which says 207. So the 207 says that price has not been at this level for the last 207 bars. We're looking at a 1 minute chart, so 207 minutes there. But what you can see if I zoom in just a little is that you can see that price has touched and just gone outside of the Bollinger Band. So this is a 20 period moving average with 2 standard deviations on either side. So price has now gone outside of the realms of normality of the current level of volatility. So should we take this trade? Yes or no? So just based on that information, yeah, you should. Based on it's a pin bar showing at an extreme level of not only where price hasn't been in the short term for a long time, but also that it's outside of the bands of volatility. But what I've also added inside here, I've also added in the RSI, the standard RSI at 14 period and the standard stochastic as well. What you can see is that the RSI is also below 30. It's also at an extreme over is it oversold, overbought? I get confused by the two. But either way, it's at an extreme level below 30. Therefore, again, showing a reason for a potential reversal. I've also put the stochastics indicator on here. Again, it's below 20. 80, 20 are normally the bands for stochastics at the standard settings. And again, even here, it's at an extreme level. And I think it's just crossed over as well. So one of the signals of trading stochastics is looking at the extreme overbought, oversold levels, and when there's a crossover within that scenario here. And as you can see, that pin bar actually does complete the crossover there. So there are two more indications here. So altogether, we've got we've got 4 factors now telling us that price is likely to reverse at this level. First one being a pin bar being formed. Second one, the location of the pin bar being formed at a Bollinger Band, the lower Bollinger Band, touching it and even going outside it. The price went outside it. Thirdly, the RSI is at an extreme level below 30, and the stochastics is at extreme level below 20 with a cross as well. So you could wait until the RSI creeps back up above 30. So after this bar, to get in here, to get in above, put a buy stop above this bar to hit the other side. With you could easily get a 2-to-1 over there. The more aggressive people. Way to trade this is to do a buy stop just above the pin bar, and if it gets activated on the next bar, which it does, it goes to the high of 7.5 pips, with a 2.5 pip stop. So you're making just around 3-to-1 risk to reward there for that particular trade. So that's an example of how you can trade Bollinger Bands with pin bars using confluence factors such as the RSI and stochastics to kind of even prove to really get your confluence with confidence levels up of taking this trade. So the third way is support and resistance level. So I showed you in the MA pullback one as another confluence level is where price was at a support and resistance level, which was more likely for the pin bar to succeed. So in this example that I'm going to show you, a chart on the Euro USD on a 5-minute chart, mid-October, 12th of October, and the pin bar. It doesn't take a genius to work out which pin bar we're looking at here. We're looking at this pin bar over here that has, the number 3,636. So what that number represents is it represents that this is the last time price was at that level in terms of bars. So it was there 3,636 bars ago. So that is a 5-minute chart. So it's it's a long time. It's a long time. So talking about confluence factors, that's one factor in itself that could be potential for a reversal. So, but the main reason why we think that this is a good thing for a reversal is that it is on a strong resistance level. As you can see, price touch once here, once here, once there, and again over there. So 3, 4, potentially 5 times, you count this red bar after the fact, 5 times that price touched that level. So having that fact there is a strong indication that that price at a minimum is probably going to go back to this support level, which is over here. So at least then, even then, that is 4 or 5 pips, and it's probably a 3 reports. So that's 1.2, 1.3 to 1 at a minimum. But you can see it comfortably broke through and price sold off dramatically. So you can just imagine the risk to reward if you put your stop up there, sell stop just for a few pips below, and boom, you know, you'd have easily got your 3 to 1, 4 to 1, whatever it is that you're looking for inside your trading. So again, another example of one way you can trade pin bars is that support and resistance lines. So if you see a pin bar form and you can quite clearly see that it is against resistance, it is very likely that price will then drop at least to its first level of support. So I hope that makes sense. And then lastly is room to the left. So in my previous videos, when I explain in more detail about the indicator, I talk about the rules that I use, and the word room to the left comes from a trader called Walter Peters in his book called Naked Forex. And what he talks about here is where price is at a rejection level, yeah, how much room to the left is there? So if we take this example here, like I said to you before, price has not been there until 3,636 bars ago, times by 5 minutes, however long that is. So if I zoom out over here, you can see prices, you know, 3,000 bars back. So you've got to go quite far back. And this is what Walter talks about. There's a lot of room to the left. So visually, you can see that there's a lot of room to the left here. And that's why that number's quite high. And I've tried to, you know, trying to put rules around it for an indicator, trying to sort of rooms to the left. I think room to the left works really well at higher level or higher time frame trading, because it means that price has not been there for a very long time if you get such a big number. And the example that I'm going to show you now is on the Euro GBP chart over here, and we're going to be looking at this pin bar that is formed over here, 2,291 bars. So what that's saying is the top of this wick, this rejection wick, if I zoom in slightly, the top of this rejection wick here, price has not been seen for the last 2,229 bars. In this case, a daily chart, so it's not been there for 2,291 days. Now, how many days? So, you know, it's about 6 years. 6 years price has not been at that level. Yeah. And the fact that it's formed a pin bar means that it's extremely likely that price is going to reverse. So I just wanted to confirm that thing. If I go on to a weekly chart for a second, and so actually might need to go to a monthly chart. Yeah, so the pin bar was here. Just having a look. Yeah, so price last was there. Guessing would have hit this bit here in 2009. Yeah, about 6 years ago. Yeah, that price was last not seen there until like 2009. Just if I go back to the daily chart over here. So yeah, so a long time. Yeah, so that's what we mean by room to the left. The longer the room on the higher the time frame, the more likely that it is that price will reverse. But also, again, using confluence factors here, not just trading pin bars on their own, using other indicators and other tools we have available to us, we can, you know, confirm this a lot more. So here's another few ways on what I've used. So firstly is a Bollinger Band. So again, price is outside of the realms of volatility over here. Secondly, I've put an RSI on, and RSI is at an overbought level. Extremely overbought there. What's that? RSI strength there, 80. So normally it's 70 is the rule of thumb, but 80. Also the stochastics also above there. And we've also got a cross as well. We've also even got a bit of divergence here. So again, divergence is where price is doing one thing and the oscillator is doing something different. So in the RSI case, you can see price is making higher highs, RSI is making higher highs. But here you can just see that, if I go on this section here of the stochastics, that's a high there, and price is here. And then where the pin bar is formed, there's another high, but it's actually a lower high, and then price is making a higher high. So what that means is that even though price is making a higher high, but the stochastics is losing steam, giving us another indication that price is set to again reverse from this scenario here. So if I have a look over here, sell stop just before 400 points with a stop of, worst case 100, between 800 to 800, so you can easily make over 4-1 on that particular trade. So again, this is room to the left, higher the time frame. Visually, the more room you can see to the left, the bigger the number, the stronger the indication of a reversal. In this scenario, we've got price above a Bollinger Band, RSI in an extremely overbought, stochastics in an extremely overbought, with a crossover, with also divergence between the price and the indicator. All those factors added together, it gives you a strong indication of a downward move, and in this case you can see a massive downward move of that factor. So that's really about it, really. So those are the 4 ways that you can use it. Again, MA pullback, continuation of the trend, Bollinger Band, using outside volatility at support and resistance level, and also rooms to the left of price being an extreme price that's not been there for a while. So I really hope you enjoyed this video. Please subscribe, like, comment. Any feedback you've got around the indicator, please let me know, and I'll look forward to speaking to you all soon. Thank you.